This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So a company that is classed as large, i.e. its augmented profits exceed 1.5 million, then they have to pay their tax quarterly. The revenue don't want to have to wait for the corporation tax once a year, 9 months and 1 day after the end of the accounting period. So it's quite a big distance that they have to wait. So if they are large with augmented profits of £1.5 million, then they have to pay their tax quarterly. So from the 1st of April 2023, the profit threshold is divided by the number of associated companies as at the end of the immediately preceding accounting period. For any exam question involving quarterly payments, the number of associated companies will be given you. So that's the rule. This gets a little bit complicated. Students find this a little bit difficult to deal with, so you may need to watch this little section several times. I have an illustration here of how it works. So for the year ended 31st of March 2024, quarterly had TTP of 480, dividends not from a group of 40,000. It had the same level of profits for the year to the ended 31st of March 23 with 2 associated companies. So quarterly limited is classed as large for the year ended March 24 because its augmented profits exceed the threshold. So you see here, that is the limit at which you pay quarterly installments, and there are 3 of them, so it's 2 plus 1. Therefore, their augmented profits, which we worked out to be those 2 added together, is over that limit which has been restricted. So they have to pay quarterly installments. So the profit threshold is divided by 3 because they have 2 associated companies. No exception applies because quarterly limited would also have been a large company for the year to the 31st of March 2023. So basically this is how it works. So you may need to just look at that again. So that's all the working out of how to work out the tax. It's not the easiest thing in the world. You may need to go back and do that again. It is going to be tested. It's the first time that it's come up in an exam. So you may get some Section A little questions on rules, but you may get a corporation tax question in Section C this time where you've got this situation that you need to deal with. So please, if that's the case, I need you to be able to understand what we've been through, upper and lower limits, how to do the formula, what happens if there are associated companies, what happens if it's a short period, what happens if there are dividends. All of those things, they lead to these mega rules that we've got now. So we've been talking about TTP. So let's have a look at what TTP is. Now this is very similar to an income tax computation. Basically, it's the pro forma that brings all the different types of income that an individual company or companies will have and brings them all into the same one. So it's the pro forma for the corporation tax computation, all those various sources of income. Now, interestingly, the adjusted profits calculation is exactly the same as it is for the income tax, except for the fact there is no private use of anything. If you see private use in a corporation tax computation, ignore it. Capital allowances is exactly the same as it is for an individual, except for the fact that there is no private use. Companies do not drive cars. So those rules we have discussed in previous chapters, and you need to go back and read those and make sure you understand them. So it looks very much like an income tax computation in that sense. So we have some interest receivable, other income, property income, gains. Now companies do not pay capital gains tax. they pay corporation tax on their net chargeable gains, which gives us, if you add all that together, it gives us total profits. QCDs are qualifying charitable donations. These are donations that have been made under the gift aid scheme. They are adjusted in the adjusted profits calculation, and then you get relief for them here against your total profits. Now that's slightly different from an individual. An individual would get their basic rate band extended and their higher rate band extended by a gross gift aid payment. Here you deduct it from the adjusted profits as you would for an individual, and then you give relief for it in full under the total profit. That will then give us TTP. Notice, dividends received are not taxable. Dividends paid are not deductible. And obviously corporation tax is paid on gains and not capital gains tax. Royalties, they're rare, very rare now. But basically a royalty is something that is paid for a license. So if I designed a plate for Wedgwood, which is a factory local to where I live, and I designed that plate, in order for them to use it, they would have to pay me royalties. Now you're probably more familiar with Amazon Music or Spotify, whereby if they want to pay, if they want to play somebody's music, Taylor Swift, Robbie Williams, they have to pay royalties to them every time that they to do that. So basically anything that is payable is allowable, it's deductible. Anything receivable is on an accruals basis and just goes in trade profits. So let's have a look at the adjusted profit situation that again that we have we've just dealt with differently for from individuals. So the main difference is, because the rules are the same, so please go back if you're unfamiliar or you've not done that section of the notes. Please go back and read the income tax calculation figures for adjusted profits. There's a whole chapter on it which shows what you can, what you can't have, and I am going to assume that you've actually done that. I'm not going to redo all those rules here. So the main differences between those rules, which hopefully you've seen, and these rules is there's no private use. Drawings are irrelevant because obviously there are no individuals drawing down. Anybody who works for the business, any company, will have a salary which has had pay-as-you-earn deducted from it. Distributions such as dividends, as we've said above, are not allowed, and they have to be paid out of post-tax profits. Family salaries, again, irrelevant. Legal fees, this is something that you might come across in a corporation tax one. Legal fees for the issue of share capital are an expense only for companies because they are capital in nature. The expense is disallowed and added back, okay, because it's dealt with the share capital. Legal fees for patents and trademarks are allowable by statute, or that's another word for law. There's been a law that's been brought in. Interest payable on non-trade loans are added back, and the expense is then deducted under the non-trade loan relationship rules. So all you're doing is taking it out of the adjusted profits and putting it in the NTLR rules. Interest payable to the revenue is treated as non-trade. Also, tax relievable against interest income. Interest received from HMRC is taxable as interest income. Capital allowances. So basically the rules, as I have explained, are already the same, except for the fact that there is no private use. So there is an additional caveat with capital allowances for limited companies. So up to this note here, up to 31st of March 2023, for 2 years, companies were able to benefit from what was known as an enhanced capital allowance. So that was 130% of any expenditure. They were trying to incentivize companies to buy capital assets in their business. And instead of just giving them AIA, which was 100%, they were giving them a super deduction of 130%. Now that's gone. Okay, so this is no longer examinable. However, that's why it's in bold and in capitals. The disposal of plant and machinery on which the enhanced capital allowances, the 130% super deduction has been claimed, could be examined. It might not be, but it could be. So I'm going to go through the various notes here. I'm going to read them very carefully just in case. And then we've got an illustration just to show you how that's going to work. And the illustration, I have to say, has come from ACCA. So that's probably as difficult as any question is ever going to be. If it's come direct from ACCA, that's what they might test you on in an exam. So illustration number 6 could be very important. So expenditure which fell into the main pool, a 130% super deduction was available. So when that plant and machinery on which that super deduction has been claimed is subsequently sold after the 31st of March 2023, the sale proceeds are not deducted from the main pool. Instead, the proceeds are brought in as a balancing charge. For plant and machinery which fell into the special rule, where they had a 50% first year allowance, when that plant and machinery on which that allowance was claimed is subsequently sold after the 31st of March 23, 50% of the sale proceeds deducted from the special rate pool, and the other 50% are brought in as a balancing charge. Now this is going to be given to you in the exam, and as I say, this is a question, an illustration which has come from ACCA. Now normally if that's the case, then that's the kind of question they might ask in an exam that looks very, very similar to this, because they don't want to test you on stuff that they haven't agreed to. So Super Limited has an accounting year 31st of March. The tax written down value on Super Limited's main pool was 0. The tax written down value on the special pool was 28,200. During the year to the March 2024, they sold equipment for proceeds of 42,600 on which the super deduction had been claimed, and equipment for proceeds of 72,000 on which the 50% allowance had been claimed. So let's have a look at the balancing charge. So there's no computation here. What they've done is just done a balancing charge calculation. So this could be a multiple choice question in section A. This is where they could test it, rather than adding it into a capital allowances computation. This you could see is ideal for a multiple choice. So you have to work out the balancing charge for the 31st of March 2024. So the super deduction here, this 50% also goes back in. Now the special rate pool had a balance brought forward of 28,200, and we're going to deduct, whoops, too many zeros, Jill. We're going to deduct from that the other 50% of the proceeds. Which means we would have 7,800. We have claimed too many allowances in that special rate pool. This is what it would look like in a computation. So therefore we have a balancing charge of 7,800 to bring that down to nil, because the special rate pool is now empty. So that would be the total of our balancing charge. Let's move on to property income now.